What we're seeing here is the number of net long positions on WTI crude oil, essentially bullish bets that oil prices will rise. What stands out immediately is that we've now reached the lowest level of bullish oil positioning in 17 years. The last time we saw this level was during the 2008 global financial crisis. This is not a coincidence. These positions reflect investor expectations about future oil demand, which in turn reflects expectations about global economic growth. When traders are confident in global expansion, they buy oil. When they're not, they back off. And what we're seeing now is a mass pullback from oil optimism, the lowest level in 17 years. The reason why this matters is that the oil market isn't just about energy. It's actually a proxy for global economic strength. If the economy was gaining momentum, we'd expect energy consumption to rise, oil prices to climb, and bullish positions to increase. Instead, what this chart is telling us is that demand expectations are collapsing. In other words, this is less about supply and more about macro fragility. In 2008, there was obviously a massive financial crisis, sometimes called the housing bubble. If we really want to understand where economic pressure is building, we don't just watch positioning or commodities, even though oil is a major factor, but we also heavily focus on housing, as that is the place where problems usually manifest before markets or other more obvious places. This chart shows the pace of new home construction in US, which is a leading indicator of housing market health and broader economic activity. When housing starts to rise, it suggests builder confidence and economic growth. When they fall, it can signal a slowdown or recession risk. The housing starts chart reveals clear cyclical behavior, with sharp downturns during major economic disruptions such as the 2008 financial crisis and more recently after 2022. See, we're not mentioning COVID recession in 2020 as we do not consider that to be a major recession like the one in 2008. The 2008 crisis was a much more of a systemic disease in economy. As you can see, after a long and steady recovery from 2010 to 2021, new housing construction began to fall again. If we overlay interest rates from the Federal Reserve, it shows that, just like in 2007 before the recession, rates have gone back up to around 5%. Housing construction is strongly affected by mortgage rates, which also jumped in 2022. While mortgage rates have a more immediate impact on housing because they affect monthly payments and buyer demand, it's the Fed's policy rate that sets the direction for overall financial conditions. Most people mistakenly believe the 2008 financial crisis began with Lehman Brothers, but the true unraveling started much earlier, in 2006 to 2007, when US housing construction quietly but decisively peaked and then plunged. As clearly shown in the housing starts chart, the inflection point came well before the headlines caught on. By mid-2007, new housing units had already fallen off a cliff. Now, in 2025, we're seeing eerily similar signals. Housing starts have once again turned lower, and speculative oil positions are at a 17-year low, exactly the same extreme seen in 2008. The implications are clear as fewer households can afford to enter the housing market, which directly dampens one of the most important engines of US economic growth. We've mentioned this low oil demand simply means there isn't very strong economic growth. We always remind this basic economic relationship. High growth usually brings alongside it a rising inflation that leads to the central bank increasing interest rates, which brings down growth and therefore inflation. This is a very basic understanding, and while reality may differ sometimes, it is essential to say that oil long positions are quite low. Every household in the United States is dependent on products either produced from oil or oil as energy for transport. Oil is obviously reflected in nearly every part of producing goods or services that households consume. Take a look at this chart of households' personal consumption expenditures over the past 25 years. Naturally, we're seeing personal consumption expenditures over the past decades have very closely followed oil prices. Personal consumption expenditures comprise a variety of expenditures. However, it's only natural to see oil being so important. Over the 4 years, the oil prices have been dropping steadily, and PCE with them. PCE is an extremely important factor in the economy, even for the markets, because it is a measure of the total value of goods and services consumed by households in the United States. PCE is the largest component of US GDP. Just to remind, the formula for calculating GDP is based on sum of consumption, investments, government expenditures, and net exports. Consumption, making up 70%, is the main factor. It's also the Federal Reserve's preferred measure of inflation, because it reflects changes in consumer behavior, like switching to cheaper alternatives, better than other metrics like CPI. So when PCE rises or falls, it doesn't mean only spending is slowing down. but also about how strong or weak the consumer is and by extension the entire US economy. Because if the very metric that makes up nearly 70% of US GDP is falling, it's not only like a little red flag, it's the core of the economy pulling back. We keep hearing oil drives up inflation, and that is dangerous. But right now, this dynamic of oil making everything more expensive doesn't seem to be much of a threat, since oil prices aren't growing and bullish long positions are on super low levels. Now, the Fed is focusing on two major factors, and that is inflation and low unemployment. But oil is a forward-looking indicator, and right now it's flashing a clear signal. Inflation is easing, not accelerating. Energy prices are leading that move, and if consumption is slowing down, then it would only seem natural for the Fed to cut rates faster.